You're watching Stock Watch this week with me and Taoleng Lechela. Devin Shutte from the Robey Group joins me today to unpack your stock-related questions. Be sure to send your questions through via email at stockwatch@bdtv.co.za or via X using the hashtag StockWatch or via SMS 241392. Devin, thanks so much for your time today. Before we get into some of those questions, it's been a really busy week, right? Everything from economic data to monetary policy moves to even earnings coming through. I mean, for once, Trump wasn't really the focus or the only focus this week. Taking everything into account, just your general assessment of trade this week.
Yes, well done. We survived January, all 200 days of it. And in the market, there was definitely, it felt like a year in 1 month.
Yep.
And, you know, this last week of the month was definitely no exception. Lots going on at the moment. You know, you mentioned US tech and disruption from Chinese AI. That was massive. And then we had quite a few central banks around the world coming out and pronouncing on monetary policy. And that's been a central theme for the last couple of years. And my sense is that's still going to be a very big driver of markets. So, I mean, I think a key takeaway there is the Fed pausing. It was expected, but it does show that we're likely to have a higher trajectory for rates in the US. Now, remember why that's important, because the US sets the risk-free rate for the rest of the world. So, you know, the other central banks are going to be watching closely. The European Central Bank did cut by 25 basis points. We cut as well, but definitely not straightforward. And I think we can see, you know, from these first 31 days of the year, just how much things can change and how quickly. Yeah.
Really interesting how Governor Lesetja Kganyago really highlighted those global risks. You can tell that,
yes,
you know, no one really knows what could happen just because Trump is back in the hot seat there in the US. Sticking with monetary policy, Devin, how concerned are you about the Fed's rate trajectory? I mean, we know that markets are now pricing in less rate cuts, but there are even, you know, statements around rate hikes.
Yes, so I think the potential of rate hikes is growing. Granted, it's still a very small you know, probability at this stage. But I think that divergence of potential outcomes is going to create additional uncertainty in the market. I think that, you know, if I had to look at the the Fed statement from this week, I think what was good is they reasserted their political independence. That is important for a central bank. So let's hope that lasts. But my sense is they're doing the right thing. Remember, they're in a more envious position than us and Europe in that they do have good economic growth. You know, they've got a strong dollar, and so yeah, they've got the luxury of waiting and seeing. Whereas, you know, looking at us, we really need to get economic growth going. It isn't the responsibility solely of monetary policy, but you know, our real interest rates, despite these external risks that our governor mentioned, are pretty much the highest anywhere in the world. And what that's doing is keeping the estimates I've seen are about 200 billion rand a year out of businesses and household pockets that could be used to invest and to spend, and that really would be useful for economic growth at the moment. So yeah, very different scenario here, but yeah, the US is not taking anything off the table at this stage. My sense is they're going to be continually cautious, and we might see 1 or 2 more cuts from them, but probably later in the year.
You know, you would have thought the last 4 years were really difficult when it comes to monetary policy, but it seems like the next 4 years are going to be even more difficult, Devin. Let's get into some questions now. Now, the AI industry made headlines this week following the emergence of China's DeepSeek. A viewer asks, was the market rout in the tech sector over-exaggerated? I think about $1 trillion in value from leading US tech index was wiped out on Monday, right?
Yes, that's right. So on Monday after the DeepSeek announcement. So that's the $1 trillion question. You know, is this overdone or not? And I think what investors are really trying to understand is where does this disruption, where does the impact of this disruption from Chinese AI hit the hardest? And you saw NVIDIA was right at the forefront of that. I think there are a number of reasons for that, because they are the manufacturers of those sought after chips up till now. It seems that those are less in demand with the way that DeepSeek runs their AI. So that's one to consider. And the valuation was I would argue, quite stretched on Nvidia. So, yeah, but then you had someone like Meta that's held up really well and actually released very good results that showed margins increasing. So you could argue they've got an open source AI, and they potentially are able to, by using AI more effectively, able to command more advertising profit. So I think it really depends on the company. But as a whole, we've seen two big trends in US tech, and this is something maybe the listeners can just consider. One is that those valuations are looking quite stressed, particularly in the Magnificent Seven, the large cap ones. And I think that's something that they've got to think through very carefully. Does that unwind or not? And two, is there further disruption coming or not? So I think a combination of those two factors are going to make it quite difficult for investors, but yeah, still brings up lots of opportunities as well.
And I think the emergence of DeepSeek also just highlighted the costs associated with investing in AI, and these big costs that the US companies or tech companies are spending. Is this a cause of concern?
It could be. I think it's quite early. I mean, DeepSeek shook the market the beginning of this week, and we don't probably have all the facts. There are some murky details there. But if what they say is correct and their spend was 1/20th of what their US counterparts are, then that is a big issue for them. But where it is good for consumers is it will likely drive down the cost of AI, the cost of inference, and what that will do is push up demand. So my sense is ultimately this disruption is going to see wider spread adoption of AI outside of the big tech companies. And yeah, I think that'll drive productivity, lower prices, and I think that's good in general for the man on the street.
All right, let's look at the cybersecurity industry. There was a question here around F5, but I know you don't look at that quite closely. So let's just take a look at how that industry has been performing, one that's really gaining momentum as everything moves online, and the emergence of hacking and online scams continue to grow.
Absolutely. And my sense is this is a theme that will only grow in importance. We almost on a daily basis hearing about hacks and the like. And as we become more reliant on these AI models and the like, cybersecurity becomes even more important. So yeah, there's a lot of very interesting opportunities here. A very popular one is CrowdStrike, and that's one that we look at from time to time. But yes, I think you're going to be seeing these large companies, not only tech companies, but around the world, as they rely more and more on Internet 2 applications, Web 3 applications, that cybersecurity becomes the moat that's needed to protect them and their clients' data.
Would you still jump into CrowdStrike despite the troubles with Microsoft last year?
Yeah, look, I think there are some concerns around there. We're waiting at this stage, but I think the point is that cybersecurity is not going away. They are one of the leaders in that space, and still want to consider, but maybe not just yet.
All right, just your opinion then on Range Resources. Another one I'm too familiar with. I'm not sure if you know it.
No, I mean, I don't know it, but if we kind of look out to the resource sector in general, whether it's PGMs or gold, that's been a very fascinating space. I mean, gold particularly, this year I was just looking at some of our locally listed gold miners have had an unbelievable January. The rest of us there with empty wallets, but the gold shares on average are up around 30% in the last month. So they're really reflecting the what's been quite persistent demand from central banks and institutional buyers into gold as they move away from US Treasuries as kind of reserve holdings there. And so as a result, gold is pretty much at all-time highs. And I think increasingly, we were chatting earlier in the show about this uncertain year we're going into. I think increasingly people are starting to hold gold as a hedge for that. And potentially if the central banks don't get a lid on inflation, gold also has a case for holding it as well there. So yeah, very interesting space. The PGMs maybe haven't done as well, but they were really under pressure last year. And so those might be due for a recovery. So yeah, interesting space. And I think kind of to wrap it all up, we're also watching how China develops this year. They're growing that economy at just under 5% at the moment. A lot of it is consumption based, but if it moves back to more production and manufacturing, I think you could see a big tailwind for commodities. But yeah, that's still wait and see. We're not seeing too much evidence of that in the market just yet.
Let's look at those gold counters in more detail. There's a question here around Pan-African Resources. Is it a hold or a sell?
Wow, so not a buy, and I take it because it's had such a good run. I mean, I think it's doubled over the last 12 months. Yeah, that's a difficult one. I think Pan and all the other gold shares in general, they're not buying holds. I think you've really got to pick your entries quite well, and they've had a good move up. My sense is it's probably still a hold in general, and I'd include Pan in this. Just because if we are still getting that strong demand coming in for the yellow metal, these gold companies are generally geared plays on that, and so they're going to stand to benefit. So, notwithstanding the fact that they've already had a good run, my sense is if your thesis is for gold to continue to inch higher, then those gold companies are going to be good beneficiaries.
All that glitters is proving to be gold. Let's move over to the defense industry. Devin, what's your assessment of that sector, and are there any companies in particular that you're looking at?
So the sector in general does also have some merit to it. We had President Trump announcing that he wants to increase the defense spending there, I think up to about 5% of the US GDP, which is an enormous number. Also, what you have seen in the starting kind of, I don't know how long it's been 2 weeks or something. It feels like 2 years that he's been president. His pronouncement is really, instead of America being an inward-focused country, they're now looking outward again and looking to assert their dominance globally, kind of American imperialism, and defense spending ties very much into that. We don't have any exposure in defense at this stage. It's quite a murky industry, but you've got some very compelling players in there to look at. I think of the like of Halliburton and that. But stock specific, no, I'm not going to give a call on that. But I think there is definitely growing demand in that, despite the fact that and thankfully that we have probably the two live wars in the Middle East and the Ukraine hopefully coming to conclusion.
There's a question that just came through here, Devin, around European equities and just your sentiments around that, considering that growth there really downbeat.
Yes, I like the question. I mean, it's been so out of favor. We really just haven't seen much, and there's been some good reasons for that. I mean, I think the bureaucracy as kind of a general statement in Europe has been pretty overwhelming. I think also the energy prices have hurt many companies there, and then the lackluster growth, as you said, have all tied into to create these really depressed valuations. But what you've got to remember is some of those larger cap European shares that are listed there are actually global businesses, and as a result, what you could be getting is very good businesses lumped in with the fact that they listed and do service partially that geography, and getting really good bargains. So a lot of the value managers that we follow see it as very fertile ground at the moment for opportunity, and I tend to agree. I mean, I think the European banks look interesting at the moment for kind of stable mid-teen total returns there. There's some other FMCG companies and the like. So I definitely wouldn't be dismissing it. And I think with the areas of the US market looking quite stretched from a valuation perspective, could provide some nice long-term opportunities.
Personally, I would be looking at Novo Nordisk, and I will not explain why. Coming back home, we have a question rather on clothing retailers and just your sentiment on those counters as the economic environment improves here at home with lower inflation and lower interest rates, as well as, the two-part withdrawals boosting some consumers' pockets. I was looking at Truworth's update today. Sales in the UK division seem to be positive, but that Africa unit taking strain. And then earlier this week, we had Woolies out with an update warning of lower earnings as its apparel unit takes strain. I mean, that doesn't come as a surprise because we do know that Woolies continues to struggle in that clothing department.
Yeah, that's their perennial problem. So, to the broader question about South African retail businesses and clothing retail, yes, there have been some tailwinds. Disposable income is moving higher, particularly for people who are employed. Some stats out yesterday that take-home pay increased by 12% from a year ago, which is terrific. And to all those reasons you mentioned, dropping inflation, interest rates coming down, and two-part. But I think what we saw is two factors driving these counters up. The second half of last year, it was the announcement of the GNU and then the expectation of two-part. But I think what we've seen this year is that the January blues really hit them hard. And I think, if you look at you mentioned Truworths, Mr. Price, they're all down 15-20% for the year already. So, yeah, I don't think it's going to be as plain as sailing for them. Truworths, out today, the market is kind of showing it was disappointing, and I think because the actual Truworths Africa revenues were pretty much flat. In fact, I think they were negative.
Yeah.
And what held them up was office in the UK. So that's not what you'd expect from kind of the macro picture that we've just painted. And then, as you already said, Woolies, that clothing business, just a perennial disappointment. There has been increasing talk of kind of spinning out the food business and letting investors choose where they want their exposure. I think it's, probably some merit in that idea. But overall, consumer gradually in a better place, but we really need strong economic growth to push through, and we're just not seeing enough of that yet.
Yeah. Before I let you go, Devin, let's get your stock pick quickly.
Yes, so this kind of links in with what we were talking about earlier in the tech shares, particularly in the US. My stock pick is a ETF. It's the Crane Shares CSI China ETF, code KWEB. And what this is it represents a basket of the biggest Chinese tech companies in a single security. So that's the likes of Alibaba, Tencent, JD, Xiaomi, that type of thing. And what you've got here, similar to Europe, is it's a sector of the market. In fact, the whole Chinese market has been very unloved for a long time. Kind of illustration of this, the entire Chinese tech sector let me put it this way, NVIDIA's market cap is 2.5 times the size of the Chinese tech sector. So the entry of DeepSeek, and Alibaba also launched an AI this week. I think what this could do is possibly change investors' perception of the Chinese tech sector. It's definitely put it back on the radar, and potential disruption from these Chinese companies could put them back in focus. So I think it's a really nice way to get exposure. As we've said, US large cap tech is very expensive. Chinese tech is incredibly cheap. So it's a very nice counterbalance, and it's showing it can seriously compete in the AI race, and I think one to look at for investors.
All right, Devin, choosing to bet on Chinese tech stocks. Thanks so much for your time and insights. That was Devin Shutte from the Roubaix Group. And that's all for Stockwatch this week. Catch Stockwatch at 6:30 on Monday night for more stock-related analysis. Until then, stay tuned for lots more coming up right on Business Day TV.